Hello everyone, welcome back to Eve Talks Finance. I'm Eve. Today, all four major indexes moved higher again. In terms of sectors, consumer staples, utilities, and healthcare lagged behind. On the stock side, NVIDIA recovered most of yesterday's after-hours drop. Intraday volatility was still significant at 444, mainly driven by options activity. From a fundamentals perspective, as I mentioned yesterday, there's really no need to panic. In fact, if the stock dips sharply, especially breaking below $169 and then further down to $159, that would still present a long-term buying opportunity. Another update on NVIDIA, Jensen Huang commented on the Blackwell chips entering China, saying the company has already begun discussions with the U.S. government. Negotiations with the White House will take time, and it's still unclear whether some portion of these high-end chips will be allowed to be sold in China. Today's program will be fairly simple. We'll go over some updated data, tomorrow's important PCE numbers, and the latest developments with a few individual stocks. MRVL dropped more than 11% in after-hours trading following its earnings report. Was the report really that bad? How should we interpret it? I'll break that down shortly. I'll also touch on another chip leader, Broadcom AVGO, which will release earnings next week. I know some of you still hold Broadcom shares. The stock looks stable on the surface, but there are hidden risks you should be aware of. On top of that, we'll discuss TSLA's European sales data. Google rose 2% today, making it the best performer among the Magnificent Seven. And Microsoft Mest is now showing signs of forming a small head and shoulders risk pattern. I'll explain where a potential breakdown could occur. On the macro side, Q2 GDP revision raised from 3% to 3.3, showing stronger economic growth. Profits revised up from -3.3% to 2%. Consumer spending revised up from 1.4% to 1.6%. Core PCE for Q2 revised down from 2.6% to 2.5%. So overall, the economy is accelerating on one side, while inflation data appears to be easing. This sends somewhat mixed signals for the Fed's potential rate cuts. Tomorrow we'll get the July PCE inflation report, which is the Fed's most closely watched inflation indicator. Headline PCE expected 0.2% MOM, plus 2.6 YoY basically flat versus June. Core PCE ex food and energy expected 0.3% MOM, plus 2.9 YoY higher than June's 2.6%. If it comes in at 2.9, that would mark the highest level since February and could complicate the case for a September rate cut. Unless the August jobs report turns out particularly weak, showing a sharp deterioration in the labor market, the Fed may not have enough justification to cut rates. We also had the jobless claims data today. Initial jobless claims, 229,000, slightly below expectations of 230,000. Continuing claims, 1.954 meter lower than expectations of 1.97 meter. Overall, the labor market still looks solid, now moving into individual stocks. MRVL and Broadcom AVGO are both key players in the AI semiconductor space. Especially in ASIC custom chips, Broadcom holds a larger market share, while MRVL is somewhat behind. You could compare it to the dynamic of NVIDIA versus AMD. But in terms of revenue scale and business size, there's still a big gap between the two. Today, MRVL reported earnings, and the stock dropped as much as 13% after hours, currently down about 11.58. Here are the key numbers from the report. Q2 revenue, 201 billion, a new record high, up 58% YoY, in line with market expectations. Adjusted DPS, 0.67, also matching analyst forecasts. So overall, the earnings themselves weren't bad at all, but the market reaction has been clearly negative, reflecting weaker sentiment rather than weak fundamentals. So why did the stock drop this hard? Now that you understand how capital markets really work, here's the big question. Would you jump in or stay on the sidelines? Drop a comment, hit the like button, and subscribe. I'll have a deeper breakdown coming up. Now let's talk guidance. MRVL's forward outlook came in a bit lighter than expected. Next quarter EPS is guided to 0.69-0.79. With the midpoint at $0.74, slightly below analysts' estimate of 0.72, revenue guidance is 1,957B to 163B, midpoint to 0.6B, also below the $2.105 billion consensus. On paper, the numbers are only marginally weaker than expected, but the stock still dropped 11% at one point, nearly 13%, which, in my view, is an overreaction. The after-hours sell-off into the lows looked very similar to what happened with CrowdStrike CRUD yesterday. I'll expand on that in a bit. Looking at valuation going forward, this earnings release hasn't really changed my outlook compared to my last update on MRVL. I'm sticking with my previous projections. Here are two frameworks for reference. One, comparing with Broadcom AVGO, based on AVGO's current P or E range of 20-30x. FY 2026 Jan EPS guidance, 5.55.820, midpoint 68. If MRVL trades around $68 after hours, that basically prices in the midpoint of this fiscal year's EPS. FY 2027 Jan EPS forecast, 7.10.850, midpoint 88, that implies a fair 6-12-month trading range between 70-88. Meaning, if MRVL falls below 70, it starts to look fundamentally undervalued, a potential long-term buying opportunity. But here's the catch: the technicals. Unlike CRUD, which has multiple support levels underneath, MRVL's chart looks weaker. MRVL broke above $75 earlier, forming a right-side trend. Its key support now sits around $66.4. After hours it touched $66.9 right at critical support before bouncing back to close near $68. Key technical levels now: if it opens at 68, there's risk of a breakdown. If it opens in the 68.3, 68.5 range, that's still weak, and it could break lower. If it loses 66.4, that confirms the uptrend structure is broken and short-term momentum is gone. Resistance has now shifted up from $75 to $77.8. In summary, below $70, fundamentally undervalued, attractive for long-term investors, breaks $66.4, uptrend is over, stock enters a downward consolidation phase. For swing traders, safer to wait for stabilization before re-entering. For long-term holders, this is a time over price situation. Patience pays, wait for mean reversion. One more scenario: if pre-market narrows the drop and the stock reclaims $74 plus. That's a strong signal and could set up a CRUD-style rebound. If it opens between 68.74, that's neutral. We'll need to watch intraday price action. Now on to Broadcom AVGO. AVGO's stock has been ripping higher with basically no pullbacks, but that's a risk in itself. We've said before, AVGO is in a unique phase, with growth running hotter than its historical average, which justifies a higher multiple. But here's the debate: why not value AVGO like NVIDIA at 30-40x earnings? Here's my take: AVGO's cycle runs faster and doesn't reflect the same long-term stability as NVIDIA. That's why 30x is safer. At T40x, you're taking on much more risk. Example: FY 2026 OCT EPS upper range, $24.8. At T30x, fair value $7.44. At T40x, fair value $990. Right now, the stock is already trading near the upper bound of FY 2026's valuation range. Even at 40x, it's no longer cheap. You could argue it's already close to overvalued. On top of everything, we also have the upcoming September 4th earnings report next week. From a technical perspective, after the recent strong rally, the price action has already formed a clear distribution pattern. I've marked out weak, medium, and strong support zones for you. What does that mean? Weak: these are areas with relatively light trading activity. If the stock drops back here, support will be minimal because not many investors have cost basis in this range. Medium: these zones represent denser cost concentrations. If the stock falls into this area, support will be stronger as more capital is positioned here. Strong: this is the most critical defense zone. Costs are highly concentrated, and when prices reach this area, it often triggers large-scale defensive buying. This way of thinking is relative, and the zones shift as price action evolves. The empty zones in between are vulnerable if earnings simply meet expectations without a major upward revision. The market could get spooked, similar to what happened with MRVL. Even though it's still a high-growth company, the stock could face short-term pressure. The same logic applies to AVGO Broadcom. It's also a high-growth stock, and as long as there's no downward guidance revision, any sell-off should be manageable. The issue, however, is that the current price has run too far ahead of fundamentals, leaving little solid support below. If the stock pulls back, it could be quite sharp. In other words, unless earnings guidance is revised higher, upside potential is limited, while a $20 drop back toward $280 or lower would still be considered reasonable. So here's the key takeaway. From a fundamental perspective, there are no signs of growth stalling. There's no urgent reason to sell. But if you think the stock has run up too quickly and you don't want to take on the risk of holding through earnings, trimming positions and locking in profits is also a rational strategy. From a technical perspective, there's no obvious reason to reduce exposure right now. Overhead resistance is minimal, with only the previous high around 3105311 acting as a cap. So technically, there's no sell signal. But from a valuation standpoint, the stock is looking stretched. Whether you reduce positions comes down to your personal investment style. I'm just pointing out the setup so you don't get blindsided by a situation similar to MRVL. Now let's touch briefly on a few other names. TSLA, we got some fresh data today. The European Automobile Manufacturers Association reported July sales. Tesla sold 8,837 vehicles in Europe, down 40% year-over-year. For the first 7 months of 2025, cumulative sales were 119,013 vehicles, down 34% compared to the same period in 2024. So, is this a case of the entire European EV market slowing? Not really. European EV sales in July actually rose 34%, but Tesla's market share slid from 11% to about 5%. Year to date, its European market share has dropped by about 8 percentage points, down to just 8. Clearly, Tesla's share is being diluted. Yes, Tesla still has big long-term visions like robotaxis and humanoid robots, but the foundation of its business remains car sales. If car volumes shrink, then the potential market for its autonomous driving software shrinks too. After all, if you can't sell cars, who are you selling the software to? Fundamentally, Tesla's auto business urgently needs new growth drivers. That said, Tesla's stock has a very unique trait. It trades more like a swing trader's dream than a fundamentals-driven equity. On pure valuation, the stock has been insanely overvalued for years. Yet institutions keep buying. In fact, TSLA entered the top 10 holdings in institutional 13F filings for Q2. The logic is simple. Institutions love the volatility and opportunities for swing trading, and they know the market's greed factor is strong. If the stock ever drops back to $200 or below, it would be a fantastic long-term entry point, but until then, big money will keep actively trading the swings. For retail investors, it's not a bad idea to follow the momentum when institutions are clearly in play. As retail investors in the market, I've always said we follow the market, whatever institutions think, whatever they want to do. Even if you know they're messing around, you can only follow along. You can't fight against the major market trend. That's what we call another kind of logic following the market. Retail investors don't decide anything. In US stocks, sure, sometimes you'll hear the story of retail versus Wall Street, but that's not the norm. It only happens in very few individual stocks. Most of the time, what we should do is observe where the money is flowing. On my show, I often explain how institutions are thinking, how they're using leverage, what's driving the market up, and what's pushing it down. Most of the time, judgment should be made through the lens of capital flow. That's exactly the case with Tesla. Today, I just wanted to update you so you can better understand why Tesla is such a highly swing trading-driven stock. Long-term holdings and swing trades don't conflict with each other. You don't have to argue whether it's expensive or cheap. Sometimes you're simply not talking about the same thing. One's talking oranges, the other's talking apples. Today, Tesla's stock dropped nothing significant. It's still in the process of building momentum after a breakout. If it pulls back and breaks below 337, then we'll see longer consolidation. If it breaks below 314, that would confirm the breakout window has failed and the upside momentum is gone. So $314 is the key level. while $337 can serve as a short-term strength or weakness indicator. Now let's look at Google.it. Rose another 2% today, and its recent performance has been quite strong. For those who thought Google was moving too slowly before, it may now look like it's suddenly become active, but in reality, nothing fundamental has changed. As I've said before, despite being tied up in lawsuits, its fundamentals remain intact. Multiple earnings reports have shown that its search business hasn't been affected by AI. Market share remains stable, and Google's large language models are also performing well. Among the Magnificent Seven, Google has always been relatively undervalued. Now that other big names are losing steam, the market has circled back to Google. Seeing its stability and funds have slowly flowed in, pushing the stock back to prior highs. In this situation, chasing at the top isn't ideal. From a technical standpoint, it doesn't mean much. It's better to wait for a pullback. Google's beta is low, so there will be plenty of chances to buy on sideways moves or retracements. The first support zone is 191197, with a new minor support at 201205. There's no overhead resistance. Google is currently tied with NVIDIA as my largest holding, each at about 10%. My cost basis is around 140. I have no plans to reduce my position. Google remains undervalued, and even into next year, that advantage holds. No rush, just keep holding and follow earnings updates. Now, Microsoft broke down in the 502-513 range, and it may be forming a small head pattern. If that plays out, the next stronger support is at $462 and below, starting from $480 and lower. It enters support territory, but $462 is the real level of strength. I've already trimmed some shares before, and I've said I'll only consider adding back if it falls below $480. Right now, I won't chase at these levels. If Microsoft truly breaks down, I welcome it. If it doesn't and just keeps drifting up, I'm not going to chase either. It rose too fast, too early, and I think a pullback is likely. The odds of it returning below $480 aren't small. When the market needs to correct, it will. It's just a matter of time. Patience is key. So that's today's market update. If you found this program helpful, I'd really appreciate a like, comment, and share. Thank you. Tomorrow, our main focus will be the PCE date and whether it sparks volatility. As I mentioned before, the last week of August usually accelerates, and that's exactly what we're seeing now. Starting next week, we'll enter the seasonally weakest stretch of the year, so pay extra attention around September 3rd, historically a local high point. Of course, historical averages don't mean every year plays out the same way. In the final 10 trading days of September, the market often swings due to quarterly rebalancing, especially when leaders with big gains get sold off and capital rotates into lower-priced stocks. This isn't about valuation, it's about portfolio rebalancing, and many funds will move ahead of time rather than waiting until the crowd rushes in at the end. September is a big month for quarterly rebalancing, so we need to pay close attention to the overall market trend. That's all for today's show. Thank you so much for watching, and I'll see you tomorrow.